Thanks for tuning in to Look At My Jpeg, the podcast that discusses NFT, DeFi, and NFT financialization. This is your host, Xerox Jose, the founder of NFT Perp. The reason why I want to do this podcast is because there's just not enough people talking about NFT financialization. Look At My JPEG will be inviting guests that are builders, founders, even investors that are deep in the NFT financialization space to talk about their story, what they're building, and how you can get involved. In this episode, Gio Medici from Abacus Protocol joined us on Twitter Space live, answering some of the questions that we had about what Abacus is building. And for those of you who don't know, Abacus is a NFT valuation system that uses optimistic proof of stake to create a liquid-backed appraisal model. And it's a very interesting protocol. Once this mechanism is built in place, it opens up a lot of different financial primitives to be built on top of Abacus. And without further ado, let's welcome Gio Medici. Thank you for coming on. If there are more team members on your side who would like to be a speaker in the space, I would love to have them make a request and we'll give them speaker rights. But great to meet you, and thank you for taking the time to hop on our first episode of Look At My JPEG.
Yeah, man. Likewise, I'm honored to be here.
I was kind of like doing some more research on Abacus, and I realized you guys are on Goblin Hideout's first episode as well. So I love that coincidence. You're on our first one. We're a big fan of Goblin Sachs, what they're doing over there.
As are we.
And
if you're not first, you're last. So that's why.
Yeah, I like that. And Zach, you're also a team member over at Abacus, right?
That's right.
All right, great meeting you guys. Love to kind of, I guess we can hop right in and tell us kind of, I guess like it would be cool to hear the genesis story behind Abacus. What kind of inspired you guys to build such a cool, interesting protocol?
Yeah. So interestingly enough, Abacus has undergone like quite a bit of a facelift from what it was at the beginning. The idea came because I was speaking with a friend of mine, and they were like just learning about DeFi, and I was like kind of explaining them just a bit about what it was and like the notion that you don't really need a credit score, you don't need to like get approved by a bank or anything like that. You can just kind of get a loan. The effectiveness of that loan, I know people are bullish and bearish DeFi, but point is that it was just like, to them, it was like a really cool idea that, you know, you can get some loan almost instantly with no need for credit or any of that. And so he said to me, and this was like months ago, wouldn't it be so cool if that same thing can apply to a house? And so I was like, yeah, it would be really cool. And like, there's a ton of legislative things that need to go right, and, you know, external things to crypto that need to go right for it to be able to be possible to do this with houses. But, you know, that got the greater thought of how do you allow this with objects or items that are represented on chain or just NFTs, right? Which in the end of the day, an NFT is just a representation of a thing. Currently, that thing is pictures and, you know, passes to communities or to whatever it is, but that I think will expand over the long term to include many other things beyond just the digital stuff, right? So to include physical assets as well. And so I thought like that's a really interesting problem to try and solve, which is that how do you, in a way which like follows the ethos of crypto, where you're not just trusting one person, properly appraise these things in a way where you can then go turn around, and in the same way that you can use, you know, with Ethereum or some other coin where you can go get a loan on it via DeFi, that you'd be able to do that with objects as well. So it got me thinking about this, and then the original version of Abacus was more subjective based. So first of all, it ran on an Arbitrum, and what it was that, you know, you had this game played between a bunch of users in which all of them were incentivized to appraise the NFT with no like liquid backing really, but they put some stake on their appraisal, and to appraise the NFT based on essentially what they thought everyone else would appraise it at, and what is the one thing that you can anchor it at when you're doing something like that? The market value, right? And so using this like wisdom of the crowds, the idea was that you can generate some valuation for these NFTs from all these people. And so that was like super cool. It was cool to build that. It was like an interesting experiment and like introduction to those types of games and those like that game theory and mechanism design. But I quickly realized that there's a, that when you provide something like a subjective valuation, which that is, right? If you don't have a liquid backing, it's for the most part a subjective valuation. It's hard to depend on that wholly because I can't call on that valuation and say, look, this is the valuation that I have. I must be paid out in it if I'm someone who is depending on it for a loan or any sort of NFT finance, right? You can't do that because there's no liquid backing to it. It's just a valuation and it's subjective. And I think that's a similar problem of, why we see currently in DeFi or in this world of NFT finance that you have these unbelievably high required APRs and very low LTVs because of that risk that the lender is taking on of, we got this appraisal, but we can't really be so sure about it. And even at that level, we're still taking on enough risk where we have to charge 15 to 20% APR at the very least. And so my thought was, okay, so how do you get around that? And I think the idea is that there is, there's like a synergy between this idea of like you have these people submitting their subjective votes, but why not just let them do that on a rolling basis and actually use liquidity to back that? But then the question becomes, right, not everyone has, let's say you're valuing a punk, not everyone has the 40 ETH to back their entire valuation. So then the answer is you chop it up into tranches. So you don't need that 40 ETH, right? Because since it's in a tranche, as long as you can enter that tranche with 0.001 ETH, then you have enough to submit an appraisal essentially. And then what you get from there is you get this massive coordination game where everyone is playing their own game and they, for the most part, are independent of what other people do beyond the fact that if I take a tranche, you can't take it. And now what you have from that game is you have a collective service, which is permissionlessly provided, and it's completely decentralized in who can provide it and who is providing it. And you're now providing a productive service to the NFT space, which basically, it doesn't just solve the valuation problem, but I think it's like does a little more than that. And we could get into this later, but yeah, that's like kind of how we came to where it is now and like what the product will be at launch.
I love that idea, and I love the fact that the genesis of this was a simple, valuation tool for a crowdsourced appraisal model. It reminds me of the early design of Upshot, which is one of the I wouldn't say competitor because you guys are focused on very different things. Model of utilizing a crowd to appraise for either a specific NFT or a given collection. The idea that keeps coming into my head, like the word I was looking for when I was reading your protocol on the quote unquote liquid back valuation, it's almost like a global bid someone would do on a collection on OpenSea. Yeah. So yeah, definitely. So as a lender of your collateral, as a lender of ETH, any given time you're giving a liquidity into a pool, you like to see like, all right, like if the chance of default increases as the floor price drops, or whatever happens with the borrower, where can I get my value back? Like, how am I going to get my value back? And therefore, if the answer is really unclear, the interest rate would definitely be higher, and also the loan to value ratio decreases, which a lot of times as a borrower, it's not very attractive. So that part really stood out to me when you guys are. I guess like the liquid back model is very, very interesting to me. And as I was reading through the protocol, maybe we'll kind of get into the very detailed stuff here. And we'd love to kind of take a step back for those that maybe haven't heard of Abacus and would like to know like what the general idea behind Abacus is and how does it serve, like quote unquote, lenders and borrowers on the liquidity side of things. Like what specific problems were you trying to solve with Abacus?
Yeah. So originally it was simply the pricing problem because that was a big enough problem, right? So it was very simply, how do you enable prices for people to depend on wholly on chain, right? So there's no reliance on an oracle that people can 100% depend on and use in all these various NFT finance ways. And that was the original problem that we were trying to solve. And then I think as things kind of progressed and the protocol just continued taking shape, like that thing you said, which is that it's a global bid, like hit it directly on the nose, which is what I think it becomes now. And that is that the goal of Abacus is not just to provide this pricing infrastructure, but it doubles as an underwriter via this pricing infrastructure, as well as a massive market maker, right? Because all of these pools are essentially offering a global bid, right? And that global bid is something that won't go away because it's just there, right? And it could be wholly dependent on that it is there. And so not only is it an underwriter now, and in that it provides this valuation and this liquid backed valuation that lenders can depend on and borrowers can depend on, but it's a market maker too, that marketplaces and anything that needs access to that liquidity can wholly depend on as well. And so that's why, like, I think it has grown from just being this borrower thing to, if you are a massive market maker, right? Or if you are a market maker at all, or if you want to participate in market making, right? This is a vehicle that you can now stream all of your market making through, because you're providing that same service by appraising through Abacus. But on top of that, your capital is being used double as much to underwrite as well. And for that, you're getting paid a lot more than you would get paid for the same service that you were providing before as purely a market maker. Now you're being a market maker and an underwriter, and that passive liquidity that's sitting there while you're market making is being used and actively used. And so now you're simply just doing what you were doing before, except now you can make more money doing it. And then that offers a service now as well. So then the protocol obviously can provide that larger service to any markets, to any NFT finance protocols that depend on it, to any lenders, any borrowers, whatever is needed. And so the goal now is just to become this massive liquidity kind of provider almost, right? Through this market making and everything that everyone can depend on. So, in the current token world, right, the ERC20 world of all these marketplaces and these fractioned AMMs, and they're all doing something slightly different, right? You have curve pools, and you have Uniswap, and then you have SushiSwap and all this thing, right? Imagine if you had a single pool which had all of that liquidity in there, and they were all just basically tapping into that pool. How much deeper would that pool be? How much more efficient would those trades be? And the answer is probably a lot more efficient. And so the goal is to basically create that same thing for, all of this NFT finance and infrastructure that's going to be built in the coming, months and years.
Very interesting. I think the NFT space has been operating for a long time without innovative model of thickening liquidity, especially on the bid side. We see a ton of in fact, let's take a step back and look at how we value NFTs as a culture currently on OpenSea or any given marketplaces, especially when it comes to the 10K PFPs, the large collections. We like to, as speculators or collectors, at least a good majority of us like to look at floor value as how we evaluate, what can I get out of this collection if I were to sell today, at a minimum valuation. And that, in a sense, is very dependent on the sell side valuation, and it doesn't take the bids into account. We've seen really cool protocols such as NFTX fractionalize these NFTs into a ERC20 version of it and incentivize liquidity by creating a sushi pool, and they're going to be on Uniswap v3, and there's other protocols around it, like FloorDAO, for example, that use a very unique way to almost like change the dynamic of these assets in the ERC20 version and taking in the liquidity in a yield generating way. And that's one of the reasons why people were able to commit more capital and to thicken the floor value, or however you put it. But in your case, it's a little bit different because you guys are not necessarily boxed to full value NFTs. It could be going towards different sort of NFTs. And talk to us about how exactly are you incentivizing, these people to place bids in your quote unquote tranche. And perhaps let's take a step back and tell us about in a given protocol of Abacus, who are the stakeholders? What types of stakeholders are they? What do they get out of this protocol by using Abacus?
Yeah. So the average, I kind of look at Abacus as like, kind of like in the same way that you would look at like a consensus layer, right? So like a blockchain, like a L1 of sorts. Like not on that scale of whatever, everything is going to be built on that. Although, hopefully it is more in the mode of operation. So what you have with these L1s, right, is you have people that like who receives the emissions, right? Who receives these tokens? It's the miners. And then the miners, slowly but surely get more and more and more and more, larger stakes in the protocol. And they get paid in various ways, like by having those stakes, which is, at ETH, it's the, the fees and everything. And the slow deflation is supposed to help them as well. I have whatever thoughts on that. But the point is that with Abacus, we have that same kind of like ethos, I guess is the right word, which is that the people who own the network and will continuously own the network and grab more and more and more shares of the network are the people that mine in the pools. By mining, I mean the people that appraise in the pools, right? So you have, you have these people who come in and appraise, and why would they appraise? I guess this will answer that too, right? Every protocol-wide epoch, which is a month-long span of time.
Wait, let's take a step back and maybe give us a definition of what's an appraise.
Yeah.
Like what does appraise mean, and why would someone appraise? What are they appraising for?
Right. So when you submit an appraisal, first of all, when you look at a pool, what you'll see is a single NFT or a group of NFTs in that pool. What the other thing you'll see is that the pool is basically chopped up into an infinite amount of tranches, all of 1 ETH in size. So the first tranche and the lowest tranche is 0 to 1 ETH. The second is 1 to 2, then 2 to 3, 3 to 4, so on and so forth. So with that information of the infrastructure of the pool, what does an appraiser do? An appraiser will simply come to the pool and they'll say, let's say there's a punk in the pool. They'll look at the punk and then they'll look at the tranches and they'll say, you know what? I think this punk is worth more than 1 ETH. So if they think the punk is worth more than 1 ETH, they should be willing to go in the 0 to 1 ETH tranche. Because if let's say the punk owner comes and closes the pool, i.e. claiming the liquidity from the pool, that what happens is they're basically swapping the punk into the pool. The punk is then auctioned off. And if it goes for more than 1 ETH, then at the very least, the appraiser doesn't lose anything. And at the most, if it sells for some premium, then, some premium against the total size of the pool, the appraiser is eligible for a part of that premium. So a reward piece of that premium that it sells for. And so, however, if it sells for less than 1 ETH, then the appraisers are liquidated based on a FIFO basis. And so that's why we use the tranches. The tranches are just a use of internal accounting. So appraisers can come in and choose these different tranches based on what they think the value of the NFT in that pool is, or the NFTs in that pool are. And then what happens is that the higher in the tranches that you go, since you're basically taking on more and more risk, then there's this premium that slowly spreads, and it increases the spread slowly until it gets to the maximum spread of the minimum you would earn is 75% of your normal rate of emissions, and the maximum you would earn is 125% of your normal rate of emissions. Okay, but what are these emissions? So these emissions are something called epoch distribution credits, right? So an epoch is a month-long span of time. During that month, you have all these different pools that are opened, right? Let's say you have a punk pool and a doodles pool and all these different spot pools that are opened. So in those spot pools, people are appraising. So people are appraising the doodle, they're appraising the punk, and in doing that, they're earning these things called epoch distribution credits. What an epoch distribution credit is that it's a claim on the end of epoch emission of ABC. So each epoch emits 20 million ABC in perpetuity. So every month there's another 20 million ABC that is emitted. If you own 10% of the total amount of epoch distribution credits, then you are eligible for 10% of that epoch's emission of ABC. So in that case, it would be 2 million ABC of that epoch. And so what happens is that there's differing rates that you're able to earn these epoch distribution credits based on a bunch of different factors. One of which, for example, is if you have something called what we call a hot pool, is a pool where it's in use, right? So the owner or one of the owners is currently actively, using the liquidity in the pool to back some value of an NFT. And we know that because there's a reservation mechanism, which they basically reserve the liquidity in case they want to close it. It's like a priority, basically like the ability to buy a priority spot. And so by them buying that priority spot, they're signaling to the protocol, we are now using the service that you are paying all of these appraisers to provide. And because they're using that...
Hold 1 second. By that, did you mean, let's say this pool is a generic punk pool and a punk owner or whoever it is can pay a fee to say, I want the priority right to close this pool when the value reaches what I want out of this NFT? Is that what you're saying?
Well, yeah, it's like imagine you have a pool that's backing a punk, right? And you have two punks in the pool, but with one collateral spot open, right? So what happens is that either both of those punks can decide not to reserve the pool, in which case, let's say punk owner number 1 wanted to close the pool, then it would be and punk owner number 2 wanted to close the pool at the same time. It's a race of who can submit the transaction faster to close the pool. Whereas if punk owner number 1 came and reserved the pool, let's say they reserve it for the next 5 or 6 weeks. For those 5 or 6 weeks, they have that spot reserved so that only they can close the pool.
So it's almost like a put option in a way, if you think about it. A NFT holder or supposed holder could pay you a premium for the option to take these values from this pool for a collateral.
Exactly, right? So in doing that, why may someone want to do that? Because a lending protocol may come and say, if you have a reservation, we'll charge you a lower interest rate because there's lower risk on whether or not you'll be able to close it, right? Whereas if you don't have one, maybe we'll charge you a higher one because this pool exists. So we know if we need to liquidate you, we may have the option to, but we're still taking on the risk that others close it first and that liquidity is no longer there when we want to close it, if we want to liquidate you or whatever it is. Right. So in that case, that's where the reservation comes. And so when someone actually triggers this reservation, they're saying, okay, we're using the pool. And so those, where was I before that tangent? Sorry, I go on tangents all the time. Well, anyways, the epoch distribution credits, right? So now you have these distribution credits and, yes. Okay. So if someone makes a reservation, that's a hot pool, right? And that hot pool.
What's a hot pool and I presume there's a cold pool, or what are the differences?
So a hot pool is basically someone who, it's when someone makes a reservation, right? So they're signaling this pool is in use. And so for the protocol makes money the most, if the protocol is making money at the most efficient rate when more pools are in use. And so that's why when a pool is a hot pool, we boost the pool's emissions get boosted. And so why does that matter? Because since all of these epic distribution credits are going to the same pool, right? It's a PvP game for who can get the best basically cost basis for their ABC that they earned. So if my pool is emitting at 10 times the rate of your pool, I'm getting a way better cost basis than you are in this race for ABC, right? And so
is the emission rate only increased because a pool is hot, or are there other ways for the emissions to be changed?
So there are other ways as well. So another way is, for example, we have these like this curve kind of mechanic. We don't have VABC, but it's like where you can come and allocate your ABC to a collection during an epoch. So let's say I want I'm a punk holder, or I'm a punk holder, a group of punk holders, and I want to incentivize deeper liquidity in punk pools for whatever reason. Maybe I want to get deeper loans, maybe I want deeper bids, whatever it is. So if I own a bunch of ABC and others own a bunch of ABC, and we allocate that ABC towards punk pools to the tune of, let's say, 20% of the total amount of ABC allocated, then in the next epic, punk pools will emit these distribution credits at 120% the rate of a normal pool. And so that's another way to increase it, right? So now that incentivizes people in this PvP game to choose punk pools over other pools. There's also,
by submitting the appraisal for those pools, therefore thickening the global bid on the buy side.
Exactly. The global bid and the global amount that you can borrow against your punks at like this low LTV cost and everything. And, it also incentivizes people to maybe take a little bit more risk. And so that's another way where you can boost the emissions of a pool. And so those things come together and they create a higher, this PvP game of these epic distribution credits. And so
very interesting. Yeah. Can you tell us more about this epic distribution credits? Are they free by appraising, or is there a cost basis on these credits? And what are these credits for?
There's a cost basis on the credits. And so the cost basis is based on what's called a base percentage. So a base percentage, every epoch, there's a automatically determined base target for how many distribution credits we want people to emit and purchase, right? Because the amount of distribution credits purchased is a fairly good KPI, it's a very good KPI of the level of appraisals that you're generating, right? The amount of liquidity that's flowing through the system and the amount of appraisers that are, actively appraising, right? Because that's when they actively appraise, they receive these epic distribution credits. And so what we have is this base value, which acts as a target, which like moves dynamically in the same way that the base fee of Ethereum moves. And so then you also have this base percentage that's essentially tagged to that base fee. And that base percentage determines the cost of purchasing the epic distribution credits that you've earned. So what does that mean? That means if you come into a punk pool and you put in 100 ETH worth of liquidity at these various different tranches, what happens is that when it's time to actually close that position, if the base percentage is 1%, you will pay 1% of the liquidity you provided for all of the distribution credits you purchase. And that base percentage moves up or down dependent on the level of demand there is for these epic distribution credits. So if demand is really high, it'll continuously move up until it meets some like equilibrium level. Because as these purchases of epic distribution credits happen, right, it basically generates more and more and more revenue for the protocol, i.e. revenue for the ABC holders, because 90% plus of the protocol revenues are streamed out to the ABC holders. And so when you have these credits, this, like, let's say you're emitting them, at 1% and people are willing to buy it and buy it and buy it, it could go up to 5%. It could just keep going up. However, the flip side is true too, where if there isn't enough demand for it, the distribution credit, meter, let's say, the base percentage will continuously drop until it reaches some like equilibrium point or some, when people start hitting the upper target, and then it'll start increasing and it'll just dynamically adjust itself on its own until it reaches that equilibrium point. But either way, the base percentage is what determines the cost of the distribution credits that you've earned. And so, and then that cost is then sent to the ABC holders, and it can basically be looked at as, you're paying the current holders for the right to inflate ABC.
So tell us a little bit more about these credits. Are they used in the ABC ecosystem? Can they be transferred or converted to different type of assets? What are they for?
So they are purely, the point of them is purely as a buffer, right? So we want to have this, we don't want a variable rate of ABC being emitted every epoch, because that can get out of hand, and it could just, you don't have the fine tuning power that you do when you have a direct, you have like the direct knowledge of exactly how much will be emitted every epoch forever, right? And so what these distribution credits are is it's a way that allows us to do these various things, like creating these hot pool incentives, creating these premium incentives without overinflating the pools. And it also allows the value of ABC to basically adjust on its own based on the demand for it via the concentration of epoch distribution credits emitted. And so they're very simply just basically a convertible count, let's call it, of your amount of appraising and the efficiency of your appraisals. Efficiency meaning, were you appraising in active pools, or were you appraising in inactive pools? And then it just basically, when you get the credits, you can buy them at the end of an epoch. You can buy them right when they unlock, whenever it is. But once you buy them, they're basically almost like a bond for a portion of these ABC emissions.
Okay, so they can use that bond to exchange for ABC tokens when there are emissions during after an epoch.
Yeah, exactly.
Makes sense. So tell us a little bit more about how a ABC token is used in the ecosystem. You mentioned earlier there is a staking related mechanism, and there's a revenue that a protocol generates. Does that go towards the Abacus tokens, the ABC tokens? And when we think about DeFi, we always think about inflationary, deflationary. Like, how are some of these Abacus tokens exit the ecosystem, or how they're being burned or used? How do you think about economic of supply?
Yeah. So I'll start with the use of the token. So the token, we don't have like a long-term lockup mechanism. Like the staking part is purely basically for like accounting purposes and to reward active users, right? So like an active user can be seen as someone who's like actively coming back and allocating their token supply to different collections, basically. Beyond, there's other active user checks and everything, but that's one of them. And so you can allocate your ABC tokens to a collection the day before the epoch ends. You can allocate the ABC to a collection, the day the epoch starts, if you'd like. But once you allocate your ABC, it's locked. And based on the amount that you allocated versus the amount that everyone else in that epoch allocated, so the total amount that was allocated, that's how your piece of the revenue share is determined. So what is the revenue share? How much is given to ABC, and how is it received? So what the revenue share is, basically all of the revenues in ETH that the protocol generates, 90% of them to begin, which and it approaches 100% over time, are streamed out to these allocators. Where do these revenues come from? These revenues come from 4 places. Place number 1 is the purchase of these epoch distribution credits, right? So that could be seen as basically purchasing the right to inflate. That's 1. 2, they come from Abacus, and at the end of the day is providing that service that we talked about of being a market maker and an underwriter, right? That's what we're bootstrapping. That's the service that we're bootstrapping with these tokens. And all these appraisers are providing this collective service of market making and underwriting. And so when someone reserves, there's a cost to it. It ranges from 0.7% APR to 2.41% APR. That payment, that reservation payment, is also part of the revenue. That's paid in ETH, and that's part of the revenue that's streamed out to ABC holders. So that's the second place. The third place is that upon closure, right? So if someone actually wants to exercise the option to close their NFT, there's a 1% fee that is taken of the liquidity, right? So if we're sending out 100 ETH worth of liquidity, one of that is sent to the one ETH is, is revenue for the protocol. The other 99 ETH is sent to the closer.
Which is 50% cheaper than OpenSea or Lookshare that are charging.
Exactly, right. It's way cheaper, and it's for the option to close this, right? And so we take that and we send that to the protocol. And then the final thing is that there's a mechanic, which is there may be a case where a pool closes and there's more volume of incorrect appraisals than the loss that needs to be covered from a closure. So imagine you have 10 ETH in a pool, or 6 ETH in a pool, right? But that ETH is not concentrated in the tranches of 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5, 5 to 6. It's spread out between the 0 to 1 and the 9 to 10 tranche.
Okay, so what you're saying is, like you mentioned earlier, the 0 to 1, 1 to 2, 2 to 3, a tranche doesn't need to be entirely full for people to add on to other tranches.
Right, exactly. So they could go into a higher tranche if they'd like, either because they want to, there's a higher risk premium if you're in the higher tranche or whatever it may be. There's also something where if a tranche isn't full, and you're like below some premium level, that you receive a multiplier on your reward, right? So it incentivizes the tranches that are maybe discounted because they're low risk to be basically recover that discount to some extent. The point is,
so it sounds like for an appraiser, a very safe way to contribute to the protocol and I guess earn some yield is always just put in the 0 to 1 each tranche, right? Like if we're appraising let's say an Azuki that's priced at 10 ETH, like wouldn't it make sense for like a bot just continuously be contributing and appraising to 0 to 1 and earn quote unquote yield?
100%. Yep, exactly, right. But there's a limitation where it can only receive 1 ETH in that case, right? So if there's one collateral slot, there's only 1 ETH worth of room in that tranche. So everyone's fighting for that spot, right? So all the bots will be fighting, let's say, for those spots in that case. But the cool thing also is that the person who gets that spot, each position that someone takes is basically tagged with a nonce. So that could be traded as an NFT almost, right? So we'll have this.
Very cool. You can pay a premium for it.
Exactly, right? Because it's a premium for a cent. Like if you have the 0 to 1 ETH tranche on a punk, that's risk free, right? Unless punks go down to below 1 ETH, then that's essentially a risk free reward that you're earning on your money that you're putting in there, right? And so
I know you haven't launched. Sorry to cut you off. I know you haven't launched it yet, but what can a basis like yield in terms of APR? Either in ETH, well, we can't adjust in ETH because the premium comes from auction premium. But in terms of EDC and translation to ABC tokens, what we're looking at for like a relatively risk-free 0 to 1 tranche ETH yield APR looks like.
So I'm not 100% sure of that yet, at least, because it depends on a bunch of those factors of like, how many other people are appraising, if they are appraising, to what extent, like how is the value of ABC adjusting, right? Because if there's about to be a bunch of these people appraising, that means a bunch of money is about to be paid out to these ABC holders. How is that adjusting? And then, if you're in a pool and all of a sudden it becomes a hot pool, then you're earning at 10x the rate that someone else is who is in an idle pool. And so because there's that PVP, there's a lot of variation there. So I'm not 100% sure. I think there'll be like a lot more clarity on that after a few epochs go by and you get some sense of like the rate of change and the rate of variation that kind of goes on there. But yeah, it's like it's very hard to kind of pinpoint that to start.
No, that makes sense.
And then what was I on before that? Oh, ABC.
I'm sorry to cut
you
off.
No worries. ABC, and then like its use in the kind of ecosystem. So yeah, so those are the two ways that it's used, right? You have those four forms of revenue, and all of those are sent to the ABC holders, and then 10% is basically sent to the treasury until there's like this, it's a 10% to start, and then it decreases as the treasury size gets bigger, and then basically what happens is over time that treasury percentage decreases to zero. Then 100% of the revenues are paid out in ETH to ABC allocators.
I love this it seems like a very, network supporters, therefore you guys get the value out of these operation type of approach, as opposed to a very centralized approach that we see in some DeFi protocols. What was some of the inspiration that made you guys want to go that route?
Yeah, so I think they're like they're at first we were planning on keeping a treasury, right, and then using that treasury to back the value of ABC. But ABC isn't like it's not like supposed to be like a reserve currency or a stable currency or whatever it is. It's just a mode of reward and for people to basically slowly but surely take ownership of this network, because that's what you're getting with it, right? You're taking ownership of this network. You're taking ownership of the rewards and the yield and the revenues that the network generates over time. And so that's what you're getting with ABC, right? Slowly but surely, you're getting more and more and more of that. And so what we realize is that you can have a treasury, which is supposed to back the value of it, but when you're not building something that requires some reserve type status or stable status, right? You can do that where you keep the treasury, but that backs the value. Whereas if you actually allow people to take part in the revenue that the protocol generates, that adds to the value, right? So the treasury protects the bottom, the under, the lower side of the value. So it's like, oh yeah, there's this thing, and it, maybe won't drop below this, but the added, come get your ETH, right? That adds to the top side of the value, and I think that's what we want to kind of optimize for, because that's what that's what this is. In the end of the day, you own the network, you contributed to the network. You shouldn't have to like wait till everything goes to shit to get your reward. No. You deserve to get your payment. You pay. You get it at varying rates depending on your continued participation in the protocol. But other than that, like we don't need to keep a reserve. Our cost of operation is like pretty much zero. We have our roadmap, and everything in the roadmap doesn't cost pretty much anything from on behalf of like monetary costs. And again, we're not trying to go in the market and play certain, open market operations and everything. The point is that the protocol has mechanisms that incentivize those market operations and incentivize people's, the value of this token and the continued value and growth of the network on its own. And also the other thing is the cool thing that it does, right, is that what you can do is it gives a very nice way of looking of, is this a healthy protocol? And the way you look at that is you look at how much is being emitted in that epoch, 20 million ABC. What is the cost of ABC at the time of emission? Okay, now you take that amount of ABC, you multiply it by that cost. That was the cost of operation of the protocol. And then how do you see if the protocol is healthy and growing and even eventually, hopefully, cash flow positive? You see what was the revenue that we took in? This was our cost of operation. What did we generate from this cost of operation? Is that greater than the token value minus the token value times the emission size? Is it approaching it at the, in the early days? It likely won't be greater than that, but is it approaching that? Are we getting closer to it? Did we finally pass it, right? Are we moving further and further away from it? It's a very easy metric of, is this thing working, right? And there's no confusion of where is this yield coming from? There's no confusion, right? You have these 4 streams of revenue, maybe more streams of revenue join, right? There's maybe some thoughts about what we're going to do with that later on if we reach some sort of proof of concept and product market fit. But it's very simple, and that's the mechanism itself is difficult enough to understand. And so the goal is just keep that stuff as simple as possible, right? Let them know exactly what they're getting in as simple a way as possible.
That's pretty interesting. How do you see, if you guys are now trying to allocate certain revenue for a treasury or perhaps a DAO per se, is there some sort of governance in play in the protocol? And how do you guys incentivize perhaps more features to be added on top of it, or perhaps, running the protocol, ultimately you still have some human resource costs, perhaps on marketing or certain protocols like features being built on top of it, new contracts need to be coded. How do you guys envision the growth on that end, and we'll cover the costs on that?
Yeah, so I mean, we have most of our roadmap. We've already basically built. It's just literally we're waiting to see, if certain things fall into place. Like if we reach proof of concept, release this. If we reach product market fit, release this. If we reach a certain amount of liquidity flowing through the system, release this. If we reach a certain amount of requests for, let's say, unique NFTs or unique collections, release this. Right. So it's more like everything is planned out and basically built for the most part. And it's more just a matter of these certain, certain milestones need to be hit. And when those milestones are hit, it's like, this is going to be released next. This is going to be released next. This is going to be released next. And so I would say 80 to 90% of that is already complete. And then it's just a matter of, our governance allows for 4 things. So 2 of them is adding and removing a whitelisted NFT collection, right? So there's a game theory problem, which is that you can't have an infinite amount of collections supported, but you can have some large finite amount of collections supported. And so our governance allows for the adding and removal of a collection. So those are 2 of the choices. Another choice, the third choice, is it allows you to add in what's called a factory. So a factory is where this core update will come from, because a factory is what allows you to create new spot pools that are able to generate more of these distribution credits, right? So it allows you to add in these new features. And so the way you would add them in is someone will come in and, they'll propose it, and then there's certain governance requirements and certain, fail safes and all that stuff, which make sure that there's a certain amount of interest staked on that and all that. The point is that you could still propose a factory. When you propose the factory, there's a vote on it. There's a certain amount of quorum that's required. And every time a factory is voted in, voting in the next factory becomes a little harder. And then a little harder and a little harder and a little harder. And the reason why is because what I think is that this mode of governance and the general way governance should work in the long run is that it oscillates between decision making, but in those oscillations, it gets to some point of being stable, where it's no longer right. It gets to some optimal point. And so I think the equivalence with this is that you reach there, but it's not time based. Right. So you're not on some time crunch where it's oh shit, we didn't reach this milestone, but it were 2 months, 3 months past where we thought we would be. And now, it's really hard to pass this governance vote because there's that time restriction, which makes the quorum go higher and higher and higher. Rather, it's, wow, we hit this milestone. Okay, maybe the protocol, maybe it should be a little harder to add in a new factory, right? Because that can have an effect on the protocol. Maybe it should be a little harder to, there's this thing that we call a positional movement, right? Which is that, it's every time a new factory is added in, this positional movement determines how much the quorum increases for the next time someone wants to add in a factory, right? So, you could think maybe it's time to increase this positional movement value, right? And so those are all things that kind of allow the protocol to, in a healthy, like non-time crunched way, to approach this like optimal, this optimal state in the long run, where it no longer needs to have these huge updates, and it could just be a matter of, oh, we want to whitelist this new collection. Someone puts it up for a vote, community votes on it, yes or no, moves on. We want to remove this collection, up for a vote, community votes on it, yes or no, moves on. Right? Because I think that's the one thing that should stay open forever. But I think the other things, like the factory and all that stuff, I think that should oscillate almost like to a halt in the long run.
Yeah, I think there's a certain level of governance that need to be designed from in a way that it can be agile, but at the same time, not everything needs to be decentralized. I'm convinced that most DAOs don't work in Web3 because, to quote Henry Ford, when you ask what people want, you're going to tell you they want a faster horse. So not everyone in a DAO situation can contribute or have the ability to make good decisions. So there are certain parameters you need to set in place to prevent slow growth, or you can name different downsides of having that. Very interesting. Thank you for covering that. One of the questions I have would be, in a given environment, like looking at NFTs right now, most of the NFTs that are, people resonate with, that are well known, that are popular, that are valuable, are the 10K PFPs. Do you think we're going to trend towards like keeping in this direction? What do you think they're going? And do you think Abacus is used for a much bigger, meaningful way, as opposed to a Twitter profile picture that's worth 200K?
Yeah, I mean, I think the end state of NFTs, I think, have reached a level of product market fit that tokens, maybe they have reached, but it's been a lot harder and it took a lot longer to reach there. And I think the reason why is because when you look at an NFT, you could package all of the technology and all of the utility behind it into, wow, this is a nice picture, right? Or, wow, I can use this as my NFT PFP, or whatever it is, right? You don't have to understand, what is the utility behind this? What am I going to get? How am I going to make money? All this stuff. Although some people do that, and that's open for understanding, right? If you want to understand that, you could. Whereas with a token, you need to understand that because there's no tangible connection to it. Other than like, oh, it's some, something that some number that goes up and down if I buy more or sell more, right? And in order to actually like visualize this and make it somewhat tangible, I need to connect it to a protocol. In connecting it to that protocol, that means I need to know what the protocol does, and then I need to understand how it's used in the protocol, right? So it's a lot less tangible unless you're able to understand all that information, which makes it a lot less of a black box, which makes it a lot harder to understand, right? And so you have all these people that have seen these NFTs, and they're like, most of them, they're not DeFi native at all, right? They have all of their exposures in NFTs, right? All of their time is spent on NFTs. And I think the reason is because it's very simple to get there. And so I think NFTs have reached this fork in the road, or are slowly approaching this fork in the road, where a choice can be made. The choice can be made between, do we want to try and recreate the entirety of the world's assets online in this digital form, right? In which case, you could do that, but you're about to try and recreate like a $1 trillion worth of, like, $100 trillion worth of assets at the very least. Which is like, maybe it's doable, but I think that's like trying to recreate a wheel, and maybe the way that it doesn't need to be recreated, right? The other way is that we have this, booming online world, right? When metaverses really become a thing, and there's really this level of use for these NFTs, I think what will happen is you'll have that world, but you'll also have some connection from the real world. And I think that needs to happen. That's like a more viable way of like betting on NFTs really becoming a thing. Because what is an NFT in the end of the day? It's just a superior mode of transferring the ownership of an item. So I own this. I want to sell it to you. I can either sell it to you through, eBay recognizing that I sold it to you and then clearing the sale and everything, or I could sell it to you on this network that is Ethereum, where there's no singular custodian. And the transaction will clear in, a minute. And I don't need to wait for PayPal to clear it. I don't need to wait for Visa or MasterCard to clear my credit. I get the money right away. you get ownership of the item right away. That is a superior mode of transfer. And so I think that is something that, as the world understands, I think it'll slowly basically be moved towards the second fork and the second path in that fork in the road, which is that we're going to now start not only having this whole online world, but we're going to start tokenizing these real world items to have them, basically use this superior mode of transfer and make this world of transferring and e-commerce and all that stuff, a lot better and more efficient. And I think as that happens, right, the span and the reach of Abacus expands too. And it enables the reach of NFT finance and all of those things as well to expand their reach in a less risk on way than we've seen them try to expand their reach as is. So I think that's what I would say the goal of Abacus is too, is that when all these things happen or all these things start coming on chain, right, when all of that fun stuff happens, whether it's digitally native, whether it's on-chain native, whether it's real world coming on chain, that Abacus is a pool and a like layer zero of liquidity that allows the ease of transfer, the ease of financial assets, the ease of financial tools to be built on top of these things, whether that's through market making or underwriting, to kind of make this just an overall more efficient and more powerful space to like operate in and everything.
Absolutely. I love that. I think when I zoom out and take a look at the transformation of how value is exchanged between hands, from culture to civilizations to now in a very zoomed in Web3 way, if I think about the very inception of DeFi is the idea of removing that middleman, that trusted party. It kind of unlocks a lot of barrier between people, buyers and sellers, lenders and borrowers. We think about, when Satoshi Nakamoto really worked on Bitcoin was, a year after 2008, where the big banks that essentially failed us, the people that we're supposed to trust and, took advantage of the situation. We think moving forward, and after Bitcoin and the power of Ethereum allowing smart contracts and law to be coded and value to be transferred, I think a lot of the value is unlocked on the financial side, at least for the ERC20 tokens. We saw the rise of Aave, MakerDAO, Uniswap, allowing users to become the protocol owners and people that take fees because of this joint trustless matter, that we no longer have to trust a third party to either appraise or provide liquidity or give you credits or underwrite. I think the NFT finance space is seeing so many different ways of, sort of like unbundling the centralized model. Like if you think about like SudoSwap, what they're doing is they're unbundling the centralized exchanges like OpenSea, for example, that are charging crazy fees. For them, is a way to unbundle that manner and unbundle that structure for allow participants and users to create markets. And in a way, for you guys, it's an unbundling way of creating liquidity for collections and allow users to bid, appraise in a way where they can get incentivized. But really, what this is inspiring is because you can kind of unbundle the sort of centralized and trusted, way, allow people to trustlessly move finance in NFTs, which has been pretty hard, to be honest, pricing NFTs. So that part is incredibly inspiring.
Yeah, and something else on like this notion of, the use of NFTs in this world, right? Is that there's like a unbelievable, like this is one of my favorite papers I've ever read. It's by Nick Szabo, who, if you don't know him, he's like one of the people who, like one of the first ever Bitcoin miners. There's all these theories about him and Hal Finney being Satoshi, all that stuff. But the point is, he wrote this thing a while ago, and it talks about it's like titled Artifacts of Wealth. And what it does is that what it says is that if you look through time, humans have continuously optimized for being able to store and own things, as well as being able to trade things in a more optimal manner, right? And so one way to view that is if you look at like a hammer or whatever it is, right, or high art or all these things, right? Certain forms of high art didn't surface or weren't, documented until later on in history and like the world's history. Because if you think about it, without some mode of transfer, like a car or a carriage or a wagon, if you're a family or you're a tribe and you have to move around, right, and you're about to travel through a desert or some land, some forest, whatever it is, right, what are you going to choose to take? A large painting or a hammer and some food? You're going to choose a hammer and some food. And so because of that, hammers and food and all that stuff, right, that stuff is looked at as certain levels of artifacts for certain cultures and certain tribes, right? Yeah, obviously it changed and, but the point is that as history progressed, you were now able to hold that art. You're now able to transport that art, that high art. And so those things and jewelry and all that started taking hold as like these collectibles, right? And so what NFTs enable in that same way is that NFTs enable that same sort of storage, that same sort of representation of ownership in a digital manner, right? So it's not just like, oh, this digital picture, but it's like a superior form of owning these things and transferring these things. And for that reason, it enables a whole new world. The same way, the ability to transport these paintings enabled a whole new world of culture and a whole new world of trading and collectibles and all these things. And as time went, that same thing happened for a bunch of different artifacts, right? Now shoes, now, books and all that fun stuff. And so, yeah, I think it's like, I really do think, and I honestly think NFTs will be bigger than tokens at one point. That's just like my own take, I guess, on it. And I think it's like, there's like a really powerful thing to offer the world here, right? Beyond some form of speculation that needs to be unlocked through a next level of liquidity, a next level of interest and understanding. And I think the goal of that's our goal, is to just make that click.
Yeah, absolutely. And it is very I think it puts us in a very fortunate situation to be building around this space, because as you mentioned earlier, the genesis story was just you trying to figure out what's a good way to appraise for an NFT in a more subjective way and a value back way, and then it trickles down to, oh, wait a minute, this can be used for this and that, and it opens up a lot of opportunities for more products, more features, more ecosystem to be built around it, and then can be applied to so many things. Right now, we're kind of in this little crypto NFT, echo chamber. But one day this is going to be applied to many different things in the world, and I'm incredibly grateful to be building, toolings around this space. I think there's a lot can be built. We're still super early. One of the things that really stood out to me was as I was reading through your paper, started to realize like this is a very clever way to accrue value, quote bit side value especially, and it creates a lot of financial hedging solutions for some of these collectors. If you think about the protocol, even though you guys are not branded as an option protocol, but in a way it is, and I feel that as you mentioned earlier, someone can pay a premium to reserve this option to close the pool as a priority. Like if that is an NFT, that becomes essentially an option contract that could be traded. So there's so many opportunities here that I think could be captured, and we're incredibly impressed and bullish on Abacus and the applications around it.
Yeah, I mean, and who knows? Hopefully, Abacus and NFT Perp can cook something up.
Absolutely. I mean, we're here. Like we don't have the as I guess like great of an ethos compared to you guys into adding liquidity into this ecosystem. We're more degen, which is want to allow people to speculate on floor prices a little easier, can short and whatnot. That's sort of our immediate short-term goal, but will be cool to look into different ways to collaborate. I think the spot liquidity in general, it's very, very lopsided. We would love to create more ways around innovations and ease of trade and capital movements for NFT finance or any NFT collectors.
Yes, sir.
Yeah.
Yes,
All right. I think that kind of wraps things up. Is there any leaving parting notes you'd like to let the listeners know about? Where do we find out more about Abacus? How do we follow you and all that?
Yeah, I mean, thank you everyone for taking your time to listen to me answer some questions and ramble on. Um, but really, if you want to, get more into the Abacus ecosystem and get trolled a little bit when you join the Discord, you can find us at Abacus_WTF. And when you join, just keep an open mind and be curious. When you see things you don't know what they mean, ask what they mean, and you will be told what they mean. Yeah. Honestly, just thank you everyone for listening. Thank you, man, for having me on here. Always a pleasure to talk to an interesting fellow.
Yeah, thank you for joining. For those that are listening, thank you for tuning in for our first episode of Look At My JPEG. Perhaps in the next episode, we can open up for some live Q&As for questions from the community. But for now, thank you for listening for our first episode, and tune in next time for more NFT finance talks. Have a good one, everyone. Thank you.
Bye-bye.
Thank you for tuning in the first episode of Look At My JPEG. If you're listening here from Spotify or your Apple Podcasts, or wherever you listen your podcast audio from, give us a share and like and subscribe to our episode. And we'll see you next time. Thank you for coming.